All right, hello everyone. Today we're going to be talking about a really cool strategy, very beginner friendly. You can make tons of passive income with this, even like 500 to 1,000 a month, but a lot more if you're willing to take more risk or if you have more money in the bank. Very beginner friendly, extremely passive income, and also you can use this as a strategy to get paid before you even buy a stock. Let's get into it. First of all, I'm just going to talk about quickly what an option is. Again, check out the other video for a full explanation, but I'll go over a quick overview just in case this is your first time seeing it. So an option is the premium derived value from underlying stock. So when you are buying an option, you are paying that premium for a specific strike price to do what you want with it. Talk about that down the list. And if you're selling it, then you're receiving that premium because you're giving people that option. Okay, so then we have the calls and the puts. A call is the right to buy a stock at a stock price. Fun fact: it's called a call because they used to call the brokers used to call people over to them when they wanted to write them, and a put was something you wrote and then you put into the file bin filing container when everything was done just in person. So a put is the right to sell stock at a strike price. The call is the right to buy a stock at a strike price. Don't get confused. It's 100 per contract, so we'll go over that. But you are doing this in multiples of 100. Okay. When you're selling a call, you're selling the right to receive premium for risk of losing your shares, to sell a put, you're selling the right and receiving the premium for risk of having to buy shares at an obligatory price. Okay, so now I just want to show you guys how to actually input that order. Again, I always use TD as the reference for the stock. It doesn't mean I'm recommending it. I just use that because the platform's TD WebBroker, and it's the first thing that comes to mind. I don't necessarily mean buy this or don't buy this. I just use this as an example. Okay, so you choose the expiry date first. Okay, so the expiry date, normally we do weeklies, which means every option chain will expire the next week and the week after that. You can do it. There's also bi-weekly and there's also monthly. The expiry dates and the strike prices that you can choose vary. You'll have a lot more options if you're doing it closer to the date. So right now it's December 16th. So we'll have a lot of expiry dates along that area. And if I choose that area and I go to the strike price, I'll have a lot more in the option chain. If you do want to know how to read an option chain, it's not necessary for this trade. But if you want to know how to read an option trade, I also made a video on that. I will link it in the post below, or you can find it on my channel. Okay, so we're going to choose the expiry date, a strike price. So here's where it gets interesting. The strike price, it all depends how much risk you want to take. So right now, as you can see, it's before the market opens, so it's not moving. The last close price was $95.23. Okay, strike prices can only be even numbers, so 90, 90.5, 91, what have you. There's no 0.23 cents that we can play with. So if you want to, when you're selling a put, you have to know what your strategy is. So in the case that you do not want to buy shares, you just want to receive the premium and hopefully keep that and let it expire. You want to think about how much risk you want to take. So why do I say risk? It's at $95 right now and a strike price of 90. So if it goes down $5, I will be exercised and I will have to buy the put if it happens until December 31st. Okay. Now, if I were to choose $94, I would receive a whole lot more premium if they expired, but it is a lot easier for the stock price to drop $1 than it is $5, right? So then in the action, we're going to, there's buy to open, sell to open, buy to close, sell to close. We're going to sell to open. This one can be a little tricky. You just need to think about what the action you're doing. First of all, if you're doing a short strategy, you're going to look at the two sells, okay? And if you're doing a short strategy and this is the first thing you've done, then you're going to sell to open. Sell to open means sell to open a position, and and then if you're buying them back, you are buying to close. The opposite is true if you are buying calls or buying puts. You are going to buy to open, then sell to close. Okay. So for right now, we're just going to focus on sell to open, and hopefully it expires as well, because if it expires, we don't need to close out the position. Okay. The quantity, remember, this is this is multiples of 100. So choose how much risk you can take. So if I get a sign at $90, a sign means that someone exercises that and it gets hit at $90. I'm gonna have to buy 600 shares of TD. Okay. So this is something you wanted to do in the first place. Great. If not, then play with that. Play with that quantity. The more quantity and the closer the strike price it is to being in the money, the more premium you're going to receive. So here is a moderate amount of risk that let's say I want to take. Right, I am comfortable, for example, that it won't drop $5 in the next 2 weeks. Markets have been generally good. Omicron has already hit. News are looking okay for banks. So from my point of view, from my thinking, maybe it won't go down $5. Okay, so then we put in our order, and then we can actually see how much money we're going to get. Okay, so this is for 2 weeks. The estimated total is $132.51, and it tells you how much buying power is required to do this deal. So what makes it covered? The fact that it's covered means that I have the cash or the margin in the account to pay for it. A cash covered put is different from a covered call. A covered call can be done in a registered account, such as a TFSA or an RSP. If you're in the States, the equivalent to a TFSA RSP is a Roth IRA 401k. I don't know if there's restrictions in the States on where you can put your option strategies, but if it's like Canada, you can't put a really risky strategy, which means options level 3 and 4 into your registered accounts. Okay, so a cash covered put you have to do on a margin account, unfortunately. Okay, because there is a lot of margin that is required with this. That doesn't necessarily mean it uses the margin. It just needs to be done in a non-registered account. So this is the buying power that's required. This is how much we're going to be getting, and this is the most exciting screen that you can see, because instead of agreeing to send, you can go back, change the order, and you can play with the strike price and quantity, and you can make this total go up or down. Okay, and you can also change the expiry date to have it weekly. A lot of people do it weekly so they can receive money on a weekly basis. So let's say we were getting around $150 per week, then we would have $600 in a month, completely passive. The only thing is your nerves, right? So you're sitting there thinking, please do not exercise me, please do not exercise me. Okay? So let's go over some scenarios, just in case you're nervous, just in case you think you're taking on a lot of risk. Again, this is a strategy that you need to understand the risks of before doing them, but it can be really cool to add into your repertoire, especially if you want to buy really high quality stocks. So if you see the price dropping, right, and the markets are down, you can actually get, and you really want that stock, you can actually play with the strike price to be near in the money, and then you can probably hit the price, right? Because you're trying to make it hit the price. You're going to be receiving that premium because it was so close to the price, and them not knowing you actually wanted to buy in the first place. So if we go back to this example, I make the strike price $95, which will probably hit that, right? 95.23, and I change the quantity to, maybe I leave it 6, maybe leave it 10, and I go back to this screen. I'll probably get like a lot more premium for that because it's so close to being in the money. I wouldn't be surprised if it's $400, $500. Okay, so then you would still keep the premium, okay, but you would buy the shares. So it was 6 contracts, so that'd be 600 shares. Okay, the other one is so keep premium or buying the shares. The third one is you can actually close out your position. So remember we talked about right here the action sell to open covered. Okay, so you can actually, when you go back to close out your position, you can go to action buy to close, and then you can put in the quantity. Okay, so that if you stuck with 6, then you can close out 6 contracts, and then the difference is just the premium. So if I got $132 for this, and it's dangerously close to hitting the price, I go and I close it out, it'll maybe cost me $100. You net the difference of $30, but you don't have to buy 600 shares of TD that you didn't want to. 600 times 90 is 95. Can't do that quick math right now, but it's a lot. It's a lot of money if you didn't want to do that in the first place. Okay. So those are all the scenarios. That's all I have for today. So happy investing. Check out the covered call strategy if you'd like to do this in your registered account, and if you want to do the opposite strategy, which means making money off stocks you already have, please like, comment, and subscribe below. Let me know what else you want to see, and do check out the other videos I have: options, stock trading, and personal finance and side hustle videos on how to generate more income for your financial independence. Thank you so much, guys. Enjoy the rest of your day. Take care.